valuations that might start to be fair, you might have to think about, is crypto actually worth anything? Like, you have to take off these rose-colored glasses and just look at the world for the first time. Get off your Wally trolley.
What's a Wally trolley?
Sorry.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
What it is, Broseph?
We're just going to take a moment here, check in on my boy Doogles, growth investor over there. This can be tough times for someone like you. You doing okay? Do I need to send you a gift basket? What's happening?
I'll take gift basket anytime. We like free stuff. We just talked about that. I want some startup shirts in there. I want some joggers in there. This is my gift basket, and a couple bananas. So if you can send that gift basket my way, I'm good.
A picture of me to put on the wall behind you. Yeah. Okay. So
yes, please do. Please do. It is a tough time for the portfolio, to be frank. But we talk about this all the time, man. They got a long time horizon in front of us. It's probably more positive than it should. I would not feel good if I were getting closer and closer to retirement, right? Or something.
Yeah.
But it's so fascinating right now because so many things are unprecedented. Like the number of economic macro factors that we have that are like happening at the same time is fascinating. And I got a long time horizon. So I'm just looking at stuff dropping, being like, opportunity. That's all or question mark, opportunity, question mark, right?
Question mark.
Watching some things. So I think it's interesting. But the portfolio is definitely heart, like HRT, no vowels. Heart.
Do you have anything in your portfolio that's like completely, I'll call it counter-cyclical, but like, if the S&P is down 3 or 4% like it was a couple days this week, that is almost always up?
No, I've got nothing like that. I have nothing that is, I'll call it explicitly like hedge worthy, kind of like there's nothing that really sticks out like that. You got something?
There's this psychological experiment. So long ago, before bonds were in the greatest bubble of our lifetime, that was long-term U.S. treasuries for me. And if you flipped open the portfolio, you'd always see big gains there when everything else was falling. As we've talked about on the show, I moved on from that because it doesn't make sense in the current environment. But I still am enacting a little bit of the portfolio insurance thought experiment that we talked about.
Oh, yeah.
And I'll tell you, just psychologically, there's something about that. It doesn't have to be a decent amount of money for me, but like it just helps, to flip open your brokerage account and see nothing but red somehow has a different feeling than if you see nothing but red and something way green, even though at the end of the day, in terms of gross dollars, that might not be super meaningful. The psychological aspect of that has been fun. You should try something like that. I want to get your take on if it feels better for you, even if it doesn't really change your gross performance.
There are enough things in the portfolio that's still like on I call it daily. Not that I'm looking at it right now daily, but that'll show positive when other things are showing negative. But it's not because they're counter-cyclical. It just like happened to happen that point. And I can say that psychologically it is really helpful. And so I can imagine if there was something that was definitively positive and other things are negative, it would feel even better. Like I can get that. It is an interesting thought experiment there. So I could see that. It's nice to see green. And it kind of, when you see the two together, it reminds me of Christmas.
There we go. Problem solved.
Okay. Before we hop in, let's drop a couple notes. Please rate and review. It's very helpful. Click that rate, leave us a review, helpful for people to find us. And we're pumping that listener mail more so than we used to. Where do they find us?
SkippyDoogles@gmail.com is the easiest place.
Hit us up.
Guys, we're going to do something crazy today. I'm going to twist Doogles' arm and hopefully we get the mailbag jingle. And we have some really good listener mail that we're going to do at the very end of the show. So if you're interested in debt levels and why I'm so concerned about debt as a value investor and some other good stuff, we're going to dive into some of that at the end of the show.
All right. So listener mail at the end. Heard it here first, and you will hear it here last as well. Okay. You cool if I dip into the fishbowl first?
Let's go.
There's this Atlantic piece that I enjoyed called The End of the Millennial Lifestyle Subsidy.
This is from my boy, Derek Thompson. Absolutely my boy. Almost everything he writes is pure gold. And I don't know what award he's going to win for this article, Doogles, but he's winning something. This was great.
Yeah. The Skippy Award.
Hey, how come we don't have that already? How about how come we don't have like the Skippy Doogles? Yeah.
We should do that. And
It's
then like end of the year, we could come back and like give all the awards out, maybe like a half year and a full year. Something like that.
Yeah, what we should do is we should $7 gift card to Chipotle, just so you don't have enough to buy a full burrito and it's really annoying.
How much was that gift card?
$7. It's a joke. Let's move on. Back to Derek Thompson.
The idea of like the useless gift card is really kind of fascinating. I think I might start doing this for you for some kind of gifts, like the absolutely to the penny useless gift card. All right, let's get into the article. So the idea here behind this article is that there's been this period of time where a lot of the companies, like let's just call them the gig economy companies like the Ubers of the world, have been subsidizing so heavily from VC money, venture capital money, into their business that they haven't even wanted to make a profit. And so what that's done is that it's artificially made prices for their services so low. And Derek Thompson here is calling this the millennial subsidy. So here's a quote. For the past decade, people like me, youngish, urbanish, professionalish, got a sweetheart deal from Uber, the Uber to X clones, and that whole mosaic of urban amenities and travel, delivery, food, and retail that vaguely pretended to be tech companies. Almost each time you or I ordered a pizza or hailed a taxi, the company behind that app lost money. In effect, these startups backed by venture capital were paying us, the consumers, to buy their products. I think that is like really succinct, well-written piece there. So I summarized it a little bit earlier, but yeah, that's the point. It's like these companies have been losing money pretty much intentionally, and they've been subsidizing that lifestyle. So that is the subsidy that's being talked about. And what he's saying now is that subsidy is ending.
It's gold. And what is so great about this is not only the way it articulates it, but the fact that the timing of this is so bad. So the venture capital money was all about user growth effectively, and not about making a profit. They wanted to hook those users. They wanted to get people used to using Uber for years and years and years. And then either you slowly turn the dial to start making profit, or maybe the economy and the stock market turns and you're not quite as free flowing with that funding as you used to be. And so you have to turn that dial. I think there's a combination of both those things happening here. So he talks about the Uber ride that he's taken for years and years that has been between 10 and 20 bucks, it's kind of implied. And all of a sudden it's 50 bucks. But he doesn't have a great alternative to Uber or Lyft right now because they've spent so much money dominating the space. The quote in this article that I think wins him an award is, if you woke up on a Casper mattress, worked out on a Peloton, Ubered to a WeWork, opened a DoorDash for lunch, took a Lyft home, and ordered dinner on Postmates, you interacted with 7 to 8 unprofitable companies and that collectively lost about $15 billion. It's over.
Love that quote. You nailed it, man.
And life is about to change. Life is about to change for 1,000 reasons, but also because these companies they're not comfortable losing $15 billion anymore.
No, well, investors aren't comfortable with them losing $15 billion anymore. Is the more accurate statement. They never should have been comfortable.
But then think about all the ramifications of this. What's the time that your Uber fare goes from 20 bucks to 50 bucks? It's when inflation for all the other goods are actually up 9%. So this is the worst possible time for the consumer who, if you became dependent on services like this.
Yeah. Yes. And it seemingly, like, intellectually, when you go to that hindsight situation, you could see, okay, I should have known that this was coming, right, as a consumer. But it does kind of hit you out of nowhere at the same time. And it's happening because of what you're stating, right? Interest rates going up, oil prices going up, all this stuff kind of feeds into the environment changing, investors not being cool with it, the environment changing. You know what this reminds me of? It's maybe this, you can say this is loosely analogous, but it still reminds me of it. So I used to be a consultant with McKinsey and Company, right? Back in the day. And when you're in the consulting lifestyle, the firm pays for a bunch of stuff.
Yep.
Like you hop in that taxi, paid for. You go out to that dinner, paid for. You do some things maybe that shouldn't be paid for. You know what I'm saying? Like, it's just like there's kind of a subsidized lifestyle and you get used to this. Like when you start there, it feels kind of ridiculous, but you get used to it. And I remember when I left McKinsey and I went out to that dinner, like that place that I'd eaten so many times, I went out and ate at, and then I went, what? Like, I remember I was there.
I have to pay for this myself.
Yeah. I went and I didn't go back. Like, because it seems like, again, hindsight, like it's obvious that I have to pay for that, but I'd like never actually seen the price tag kind of because of that subsidy. So it's loosely analogous, but it made me think about this because of the potential consumer behavior change that could come from it. As I mentioned, went out to that place to eat, didn't go back again. Right. Yep. And so it makes me like I've seen with Uber Lyft for a number of reasons. There was a pre and post, maybe not, I shouldn't say post pandemic, a pre-pandemic and during pandemic, I don't know, change, like now, whatever world we're in right now, there was a change for a number of reasons. But one of them is that the price has gone up for me personally. I mean, like the price has gone up. And so like, I think not twice, I think like 6 times before I hop in like a Uber or Lyft. Like I'm a walker anyway. I might just walk. I might grab a scooch, right? Whatever it might be. So consumer behavior changes.
Exactly. And I'm gonna hop on a bike more. I mean, this is about to change.
No, I'm not about to
consumer behavior.
Let's not get ridiculous.
So he ends this article by saying, but the heavily discounted prices of the 2010s aren't coming back. The millennial consumer subsidy is over, and for the foreseeable future, Metro residents will have to go about living the old-fashioned way by paying what things actually cost. This kind of sucks. I'm sad. Why do I have to pay? Like, why do I have to pay what things actually cost? That doesn't seem fair to me.
It is. I love that. I'm glad you brought up that quote. I really love it because there's so much of our current environment that kind of just feels that way. Like we've been living in a fake world for a while. And so it's like, boohoo, tiny violin, you have to pay what the thing actually costs. Is like we're hitting that. Like you have to look at valuations that might start to be fair. You know what I mean? Yeah. You might have to think about, is crypto actually worth anything? Like it's just you have to take off these rose-colored glasses and just look at the world for the first time. Get off your Wally trolley.
What's a Wally trolley?
Sorry. You seen the movie Wally?
I mean, like
Pixar?
Maybe. Yeah.
Yes,
I remember it being boring. Right.
Okay.
Okay.
You just pierced my heart. But so in the movie Wally, the humans of the future are riding around in these.
Oh, the Wally trolleys. Yeah.
Yes. There you go. That is not what they were called.
They are now.
Anyway. So you got to take off your rose-colored glasses and actually look at the world, for the first time in a while. Boo to the hoo to the. So
Boo to the hoo to.
I thought this is really, as you mentioned, really well written, easy to understand, digestible, and is such a thought-provoking piece.
Yeah, and this is classic Derek Thompson. He puts these puzzle pieces together in a way that's really unique. Well done. We'll put it out on the Twitter for you, which is at Skippy Doogles. Let's shift gears, if you don't mind. Bill Gurley is back giving wise advice, and I just want to get your take on one thing. We don't have to spend much time on it. He did a thread this week. He's been kind of on this soapbox a little bit around people in the Valley that didn't live through 2001 and 2009, and just trying to explain his perspective of how challenging things might get. The quote that jumped off the page for me is, "There's no doubt that layoffs are brutal and real lives are negatively impacting, but not adjusting is a losing strategy for everyone." This is in the context of saying how difficult he thinks it's going to get, and that if you're at an early stage company and you have concerns about cash flows, burn rates, get ahead of it now. And if you have to lay people off, almost the sooner the better, because if you wait 6 more months and then you have to do it, the economy is probably worse, which means the people that you laid off have a harder time getting a job, and you just burned all that money paying those folks, and so your run rate is reduced because you delayed making this decision. Any thoughts?
Lots of thoughts. I mean, as always, Bill Gurley spits wisdom. I think that within this quote here, the not adjusting is the most important phrase to me. Like, even if you abstract it out of layoffs specifically, I think it's the understanding the current macro environment and your own current like business situation is important, and then adjust accordingly, because different companies will have different industry postures or different postures right now, right? So there are some organizations that, like if you take a Peloton, which we talked about before, they were, hot demand. People couldn't leave their basements. And so you're exercising there. The posture changes aggressively where like growth is now not a thing, right? Like growth is no longer a thing. There are other businesses where growth might still be a thing. Like even real growth might still be a thing, but maybe it's not as much as you thought it was going to be, or right. And so it's not there. There are some companies where you just like, you need to cut because like your revenue future incoming like has gone down. And there are some organizations where you might just need to adjust. And so the layoff piece specifically, I think that depends on organizations, but the adjustment piece I think is so critical. It's just important to step back and think strategically about where your company is, what the macro environment is, what you're going to do. Wisdom. Love is wisdom.
Yeah. And so let's talk about an adjustment that's happening in the marketplace. Klarna, which is a Swedish payments firm, buy now, pay later, one of the early pioneers in the space, I'd say, founded in 2012, if I remember correctly.
No, 2005.
2005, really?
Yeah, they've been around for
it's an OG in the buy now, pay later space.
I don't know if they've been doing that from the beginning, but they were founded in 2005.
Okay. So they had raised money towards the end of last year at a valuation of $46 billion. And you know what they're trying to raise money at now, Doogles?
Spit it.
15. I mentioned that not because I care particularly about Klarna, but because in the fintech space and in a lot of the early stage hot companies, I think it's very reasonable to say your valuation today might be somewhere around a third of what you thought your valuation was 6-ish months ago. It's craziness. Yeah. But you see that everywhere. I mean, we've seen a bunch of high flyers go down 75% that are publicly listed companies.
45 to 15 is aggressive, but you're absolutely right. And that's where and Bill Gurley's tweeted about this too before, when we've talked about the looking at 75, 85% like by itself in a vacuum objectively sounds really, really harsh. Like it sounds like a discount. It sounds like I'm at the blue light special, right, at the stock market. But when you picture that same thing went up 3x, 4x, 5x in a short period of time, you're really not going back like all that far, right? Like I'm going to get the numbers wrong. Maybe you have them in front of you, but for Klarna raised money, I think twice last year. And in January raised at something like a third of the amount that they'd raised like in June, right? It was something like that. Like it was such a change. And when you look at that, you go, oh, okay, so what the business was last January, which might have also been overinflated, is like what we're looking at. Like that doesn't seem
very true.
Drastic.
Very true. Yeah. Just to be crystal clear, because we talk about it a lot, I'm not saying that just because something went down 75% means it's fairly valued or undervalued. In a lot of cases, it's still overvalued, which is insane. It's hard for the human psyche to get comfortable with that, because you go, well, no, it used to be 46 billion, 15 billion has to be a steal. Unfortunately, that's not true.
And I've had a special place in my heart historically for NVIDIA. It's come up a whole bunch on here. And I, like in early 2000 or something like that, like, oh, NVIDIA might be overvalued. Stock goes up like 50% that year, more than doubles the next year, right? Yeah. And then I was just, the reason I brought this up, because this week I was looking at it because NVIDIA has been hit pretty hard with the rest of the tech stuff. And I was like, oh, maybe Maybe it's at a price that, that would be interesting. It's looking at NVIDIA and it's at its price of like June of last year. And I went, okay, so it's now at the price that's double the price when I thought it was overvalued. That is this kind of stuff happens all the time. So slash does not mean on sale.
Yeah, let's cut the thing in half like 2 more times, and then we'll talk.
Yeah, and then maybe.
Yeah. Craziness. All right, what's in your fishbowl?
We talked about crypto a little bit, just mentioned the words a little bit earlier today, and we've discussed crypto a good amount on this here podcast. This week, I mean, it's beyond this week, obviously, but this week, so much has come out in the crypto world because Bitcoin, which is what I'm calling it now, when it starts to drop a lot, it becomes Bitcoin. Bitcoin is getting hit so hard that it started getting to Michael Saylor style margin call type prices. Not saying that's going to happen. Who knows if that happens, but it's so interesting. I've got things to talk about because it's not actually about it as an investment. It's about its pop culture bubble pop.
Yeah.
I'll drop a couple things. Then I want to get your reaction. So let's go back 4 months. We're all sitting around eating corn chips, eating popcorn, ordering pizza, football, Super Bowl time. What filled the screen?
Fortune favors the brave, Doogles.
Exactly.
So do losses.
Matt Damon, investor of water and crypto, maybe, came onto the screen. I don't know if he actually invested in crypto, but he was in the ad, and he came onto the screen and was talking about how you gotta look at new frontiers. You gotta be brave, right? Because fortune favors the brave. Lots of commercials going on during the Super Bowl during that. So that's interesting. More interesting here, and also kind of messed up. And there's one quote that I think summarizes this really well. So Coinbase, the cryptocurrency wallet slash exchange, bought an NBA Finals ad. NBA Finals just ended. Let's just be clear. Yeah. So this is very recently. They bought this NBA Finals ad. And what the ad does, did you watch it, by the way? Have you seen the ad?
Yeah. Yep.
Okay. So what the ad does is it pulls up a series of tweets going back over the last decade of people saying crypto is dead. So different tweets saying crypto is dead from like last year, from 17, from 15, from 12. And then it ends with long live crypto. This ad comes out. You could not, Neil Stevenson, the author of Snow Crash, couldn't write something better than this. The next day, Coinbase has to lay off 1,100 people. How are you going to spend probably upwards close to $1 million? I don't know how much it costs, but a heck of a lot of money to get that commercial to say how, like, basically how thriving things are before you do that.
I'm worried my rant from last week is going to get me in trouble, so I'll try not to rant about Coinbase. But let's just say it's a bad look when your founder buys $133 million home and then just, goes out and explains why he has to lay off 18% of his workforce. They grew too fast, blah, blah, blah. I didn't even spend time reading it because I knew I was going to be disgusted by it. But so in a way, he's getting ahead of it. He's taking Bill Gurley's advice, and that's probably going to be positive for Coinbase. And I know leading a company is a very, very difficult thing. You have to make decisions like this. But man, to be a jerk about it, I don't think he's trying to be a jerk about it, but to kind of have your actions be so disconnected from, oh, I really care about my employees, but I have my $133 million mansion. I mean, how many employees could he pay for years if he didn't have $100 million mansion? There's just something we talked about it before.
It feels dirty.
Yeah, it doesn't.
It feels dirty.
I have an icky feeling when it relates to Coinbase. I also don't think, and I could be wrong on this, that he's taking most of his pay in crypto. I think he's actually taking his pay in dollars. So what does that tell you? I don't know.
But here's the quote. Here's the quote. And as a little bit of context for this, in addition to the ad that we just mentioned, Coinbase has also recently rescinded offers. So they gave job offers to people and then they pulled them back.
That's the thing that didn't make the pod last week. That really, if you talk about this icky feeling like that, really, there's a couple guys that had turned down like PhD programs or other things because of their Coinbase job offer that appear to have gotten completely screwed by the fact that the company couldn't just be fair to them.
Yeah. And here's what an employee said. I'm going to try and put myself in their shoes and channel the tone, but I'm definitely going to get it wrong, but I'm going to channel the tone. These cats really used all the saved money from our rescinded offers to buy an NBA Finals ad that said crypto is dead.
Good work. I think that's exactly how it was, how that quote went.
The most important part was these cats. I think like I can't think of how else. Or it could have been these cats. It could have been like that too. But yeah, I mean, sometimes you mentioned like not a good look, right? And it's because like you can see a quote like this when you break down logically how someone must have been thinking, like you think about the leadership of the company. And if you go, okay, I'm going to give them the benefit of the doubt, and then you start putting the logic together, I think you end with this quote. Like you end with some version of this. You go, I tried to give you the benefit of the doubt.
Yeah.
But these cats really use the saved money from the rescinded offers to buy an NBA Finals ad. Like there isn't and obviously that's not like the order of operations that happened here, right? Obviously for the company, but still.
No, and I'm not here to like throw shade on them. I mean, crypto.com spent $700 million to buy naming rights to the Staples Center. And basically since that point, crypto's performance and crypto.com's performance have been as bad as you could ever imagine. They're all cut up into crazy headwinds. When you have DeFi exchanges like Celsius, which we won't talk about in detail, not allowing people to withdraw their money, you have small crypto firms and coins effectively going bankrupt all day, every day. You know, Bitcoin is the blue chip here, and Bitcoin's down 70%. So if you're not Bitcoin, you're probably very likely to be down much more than 70%. And that makes it, those are nearly impossible headwinds to swim against. Coinbase probably already paid for the ad for the NBA Finals, but it's just a bad look. You know, like I don't think they could have changed it. But in 3 months, if they're still spending money on stuff like that, oh my goodness, not
That's
okay.
Different. That's different. And this feels like the crypto equivalent to me of the shoe shiner giving stock tips. Like the story that may or may not be true of like Joe Kennedy back in 1929 gets the shoe shine boy was like, you should buy RCA. I don't know. That's not how he sounded.
No, that was perfect. That's exactly how
I'm nailing them all today. And that's when Joe Kennedy was like, I need to sell all my stock because this person, right, is giving. It kind of feels similar when you get like the crypto.com arena pops up. You get celebrities pumping crypto during the Super Bowl ad. You're just like, what? Like there's this thing that no one has figured out if it actually makes sense from an investment perspective, is getting blown up in a very public, like amateurish way. Like when I say amateurish, I mean like retail amateurish way.
Yeah. So the most balanced piece that I just thought was incredibly well researched, I think just came out last weekend. It's called "The Crypto Party Is Over" in the Wall Street Journal. Brings together facts from the 20 last articles they wrote and puts them all in one place. So I'll put that on the Twitter. It's a good balanced read about some of the mania relating to celebrities endorsing it, some of the craziness that was happening with crypto founders and their mansions and the parties they were throwing, and now how that's pulled back.
Before I give you the reins back on the fishbowl, can we just talk Michael Saylor?
Oh, please. So listen, it was out there based on something his CFO said, that they could get a margin call when Bitcoin dropped below 21,000, which was fairly common in the last week. I haven't seen any reporting, and I've looked for it, that explains if that margin call actually happened. So I'm so curious. Have you seen anything?
I've seen Michael Saylor say that it hasn't happened and won't happen.
Oh, interesting. So then I've seen something else where he says it has to go as low as 3,000 to get a margin call. Is this true?
I don't know. I don't know about the margin call.
Okay.
I don't know about the margin call, but that Squawk Box interview,
yes,
with him, That is straight from the sailor's mouth.
You can't do that. I mean, that's really funny. It's really, really funny. Yeah. So can we talk specifically about that? Oh, this makes me just cringe. So
This is before you, I'm gonna let you go into this, but this is everything that's against the way that investors should think. And I don't even believe that it's the way Michael Saylor thinks. Before you hop in, go ahead.
why would you say it if it's not what you think?
He's a performer.
So I actually can't find my notes on this, but he talked specifically about how they did back testing. Sorry, I can't get through it with a straight face. They did back testing, and Bitcoin was just the best performing asset they could find. Well, Bitcoin is something that from 2009 to 2020, when he's doing this back testing, went from less than $1 to like $50,000. Of course, it's the best performing asset in your back test. You really think that's a comprehensive? You know what else happened from 2009 to 2020? Nothing but a bull market with zero interest rates. I mean, are you serious right now? You took 12 years, 11 years of nothing but a bull market on a incredibly speculative asset and said, oh, well, that means I can invest in it safely for the rest of my life. And I'm going to hold $6 billion worth of it at its peak valuation. I've currently lost more than $1 billion, more than $1 billion of my funds here, which are largely financed with debt. Like, this is the worst case. I don't care if it works out. I don't care if he rides off into the sunset and he's going to have more money than me. That's perfectly fine. It's just really poor investing, if you can even call it that.
It's dangerous. Like, straight up. I mean, this kind of rhetoric out there in the world is so dangerous for people when they're looking to understand markets and get even high-level investing advice from people. Like, because he said what you just mentioned, right? Best performing asset over any time frame, it has outperformed.
Yeah,
over any time frame. And then what are the time frame examples he gave? 2 years, 4 years, 8 years. That's not any time frame. Like, that's a very specific time frame. Like,
the thing hasn't been around for 50 years.
Exactly.
So
no one has ever lost money investing in Bitcoin over 4 years. When something's been around for 13 years, you get a low number of 4-year periods. Like, it's so dangerous.
So he also was like, well, basically saying it's a great time to invest. This is a guy that's down at least $1 billion and going, oh, this makes perfect sense. You know why? You know his valuation methodology? It was a 4-year simple moving average. So he said, oh, I went below the trend line. Well, an asset that goes up for 13 years, of course, is going to be above the trend line until it's not. And then it's anybody's guess, especially when you don't have a cash backstop and there's no fundamentals. Like, I understand the value and the positive take here. And I don't think Bitcoin's going to zero. I think it's going to be around for a very long time. I think there's a use case there. But I have no clue of the valuation now. I'm certainly not taking out debt to speculate here. So frustrating.
We've had the conversations around how do you value Bitcoin? Can you value Bitcoin? Right. And what I'm kind of starting to think about here is that Bitcoin becomes possible to value at the point that the world is destroyed.
Keep going.
That might be a little hyperbole, but when Bitcoin as a store of value, let's relate it to gold. I'm just going off the cuff here, so bear with me.
Yeah.
Bitcoin, if you view it as a store of value, gold is a store of value. Gold is a store of value historically because so much currency was pegged to gold, right? It was tied to the value of gold. And so therefore it was like you knew that governments needed gold. And so if all else falls apart, you'll have gold, right? So even if markets start to fall apart, you'll have gold. So that's like historically, gold has been seen as a store of value, some version of that. Bitcoin is when the government no longer, like the government currency is no longer really a thing. So you get like, it's like when nation states fall,
Yeah.
you still have Bitcoin, which that's what I'm talking about, the destruction of the world, not like nuclear disaster, because you still need servers. Like if servers go down, well, you don't have Bitcoin. So you still need servers, but it's like if nation states fall, we're kind of far from that probably.
Oh, but so I listened to Bill Miller on William Green's podcast this week, right? Bill Miller is the only so-called value investor, and I'm sure there's a few other that has a substantial holding in Bitcoin. And his take is simply that if you're American or Japanese or somewhere in the European Union, you've probably had very stable governments and you can trust their guardianship of your currency. And so you go, why would I need this? But if you're from Argentina or Venezuela, you understand the power of having some other assets. It could be gold in your example, or it could be something that's hopefully a little easier to transact than gold, which Bitcoin would fit the bill of something else, because you can't trust your government. And I think I still think that makes sense. But I'm not going to tell you
versus value. That's a different.
But if you have utility, you have supply demand, and if you have demand, then there is some value when there's a fixed amount of coins. Now, I'm just not going to tell you if it's dancing over there. I don't know if it's $5 or $50,000 or $1 million per coin. I mean, I just don't know, but I do think there's some value there.
And that's maybe I shouldn't say more than this, because I'm going to get into Nerdville real quick if I'm not already there. But I agree with you. But the utility in that circumstance to me becomes most valuable when the utility is more ubiquitous. And that utility in this world becomes ubiquitous when I said nation states fall, but I really mean when the reserve currency, like there is no reserve currency of the world, right? And like, so that is what would have to happen for what is true in, as you mentioned, Venezuela, Argentina, Afghanistan a little bit ago, becomes the norm. So you have to believe that reserve currencies are going to fall. Now, I said we're not close to that. Who knows, right? Like you never really know when reserve currencies could fall. But anyway, we'd have to go. Let's get back to our regularly scheduled program. I took us off into a nerd abyss.
Good luck to the employees of MicroStrategy. I hope your founder doesn't destroy your livelihood.
Agreed.
And best of luck to everyone. We're not rooting for anyone to fail over here. So, hey, Bitcoin could go to the moon. It doesn't harm me in any way. Go for it. Can we talk two things? Can we talk about Stanley Druckenmiller and his article with John Collison?
Oh, the interview?
Yeah.
Let's do it.
So we're bad at this because we're both investing nerds. If you don't know who Stanley Druckenmiller is, here's my blurb. Over more than 4 decades in investing, Druckenmiller has never recorded a down year. His fund even notched a return of plus 11% in 2018. And during one stretch, he compounded his assets at 30% plus per year for 30 straight years. His net worth is north of $5 billion. This is from The Hustle. This is from 2021. So pretty smart dude, huh, Doogles? Do you think we should listen to what he has to say?
Yeah. And it's a wide range of different environments. You said 40 years. I think 45 years is how long he's been a chief investment officer. You've seen some things. You've been through many environments.
Yep. And he has background kind of like me. He started in banking. So, of course, I like him. Now, this interview, I said article, but I meant interview. It's a YouTube video. You can go to @Collison and pull it up. It is from June 10th. So wide ranging. Like, just if you have an hour and you're interested in investing, just listen to it, because John Collison, who's the founder of Stripe, is just ask really insightful questions. There's 2 things that I found really interesting. The first is something that Druckenmiller always talks about. Actually, there's 3. The first is that if he was making a prediction, and he's wise to say, I'm not making a prediction, predictions are dumb, he would say the pain is going to continue and we're going down significantly more than we are down today. I think he mentioned as much as 50% more. So thoughts on that, Doogles?
I do have a thought on that. But one of my thoughts has to do with something else he said related to that. And I don't want to steal your thunder. So
no, go for it.
Well, it's interesting because I love that you brought up the fact that he said, this is not a prediction, but if I were to say what I think, because it relates to the fact that while he believes that as the case, he also said that he's not shorting equities right now, at least not in a material way. And what he said was that he would wait for a 15 to 20% rally potentially, or he didn't say it. He said, I'm going to see if there's like a 15 to 20% rally. And then that's when I might get interested again. And I thought that was really interesting. So that was my
perfect take there. No, you actually, you're helping me articulate this. So the actual quotes relating to this is, there won't be a soft landing and a high probability that the bear continues down. He thinks, and this is almost proven by current valuation methods, that the mean reversion will continue. And those are my words, not his. When they talk specifically about inflation, he dropped a factoid that I've never heard that is incredibly interesting. He said when inflation gets over 5% in the US, it's never gotten under control until short term, basically the Fed fund rate goes above CPI, which means the Fed fund rate has significant movement because CPI is currently 8 to 9%. The Fed fund rate was just raised this week, but what is it, Doogles? It's in the 1.5% range.
Yeah, something like that.
So like,
and the CPI being inflation.
Yeah. Those two things need to converge. So not only does CPI have to come down significantly, but likely the Fed funds rate has to go up significantly. The ramifications of that are significant because all debt gets significantly more expensive. That probably creates an environment where we hit a recession very soon, simply because you can't raise the Fed funds rate that quickly without severe ramifications. We'll talk about maybe later in the show what's happening in the U.S. housing and mortgage market and why there's significant impact to that through the rest of the economy.
And what's interesting to me here, there's like everything is interesting, honestly, to me in here. The one thing I'd bring up is that there's so much, we've talked about this, I think probably mostly off pod, but we've talked about the fact that there's so much that relies upon earnings over the next few quarters right now. Like I think that's one of the key factors, one that drives the market over time. So what I'm about to say is not like rocket science, but as of right now, I think so much hinges on that, because in one world, you could say that prices have dropped enough to make it so that the price, if you just look at this one valuation measure, the price to earnings ratio has gotten like reasonable-ish. It's not wild anymore, right? That's like one way you could look at it. However, that's forward looking. However, if you say that, which this often happens in circumstances like this, the forward looking earnings predictions are wrong.
Yeah.
And earnings come in lower, then we could be just as overvalued as we were 20% ago. Yep. Right. And so watching earnings is going to be pretty critical to see what happens over the next 2 or 3 earnings cycles. Do they hit as they have been? Do they hit expectations? Do they fall below expectations? And what is the outlook also of the companies at that point when they announce earnings? There's so much that relies upon that. But I love this part of the conversation that he had with Carlson. You don't seem to like what I just said, though. You don't seem to like it.
Well, I mean, I think you just know I hate projections, and like, I think that's a fair take. I wouldn't say I disagree with it, but you said if you look at this one metric, well, when you look at 10 metrics, price to earnings is the only one that looks reasonable-ish. Everything else still looks like we're in a crazy bubble. So I just would look broader than one metric.
I also agree with looking broader than one metric, but I don't think I've seen enough that says that everything else looks like we're in a crazy bubble.
Okay. Let's change some text.
Yeah.
We'll talk about it next week.
Okay.
If we go back to Druckenmiller, there's 2 other things he said that are just good. Carlson talks about, hey, you know what? I've heard your performance is really just that you outwork everybody, that you work crazy hard. And he says, you know what, that's true. But I think passion equals hard work. And I'm really passionate about investing. So that's what I want to do when I wake up on a Saturday morning. And that's what I want to do on a Sunday night. And like, I just think that gets overlooked. That's not a investing point at all. But people, if you find something you're passionate about and can do it where it doesn't feel like work, you're going to enjoy your job more. It's a huge life hack if we're calling it that. It's worth calling out.
Yeah, agreed. And in the investment world, I mean, part of what he was saying is it takes so much effort and scrutiny and rigor to do what he's done. Right. That's where like the time investment is material. You're reading through all this stuff and injecting it into your brain and trying to figure out what the heck it means. Like it just takes a heck of a lot of time because he's not looking at something on a whim and just saying, oh yeah, let's just see. Let's throw the spaghetti at the wall and see what happens. He makes big bets, right, that are very well researched.
But I got to jump in there. One thing he said was just so fascinating. He has a whole team of analysts working for him.
Yep.
And he said it's so crazy competitive right now that sometimes he gets pitched something and he was already maybe bullish on that industry or that stock. And it's like a lunch meeting. He goes back to his desk, throws hundreds of millions of dollars into this thing. Now his portfolio is massive. So hundreds of millions of dollars is a lot of money, but not like it would be for your average person. And then goes back to the analyst and says, I took a position. I want you to do more rigor. And he'll decide if he either continues to add to that position or jumps out 2 or 3 weeks later. But he said it's so competitive that sometimes he sees other people realize that story within the next 2 to 3 weeks. And that's the biggest move of the stock. What's funny about that selfishly is, listen, I'm not comparing myself to Stanley Druckenmiller, but I've found myself doing that a little more in terms of, I think this is actually, there's actually something here. I might jump in with a small position and continue to formally dive into the 10K and do those other things. And then usually you can jump out if you were wrong without much of a loss. But if you jump in, you might get that big gain early. I definitely see that.
Yeah, I think it's interesting. And it's taking this without a lot of nuance in it for the average investor is dangerous.
Oh yeah.
To be honest, but I agree with you because but there are the cases where I might see something and say this price over the long term, I know isn't bad. Like I know that. I don't know that it's the right price. I don't know this is exactly the right time, but it's not bad over the long term. Like I'm my long term right in there. So, but I agree. So like take a little bit. It probably usually for me, it won't be my full allocation. Like I'll have more than I'm willing to allocate to whatever that thing is. But yeah, I agree. I thought this part was fascinating too. I took a note down there of like trading before the research. And then there's like deep research that happens to either get to 2 or 3 weeks later, like whether he exits a position then, which he says is not much of a loss usually, or doubles down or continues to ride it. So I thought that was really fascinating. One other thing I thought was, one other thing I thought was interesting.
To hammer on that point, like you made a great thing. I always say this with Buffett, Druckenmiller's basically the same. Like this is kind of like listening to Michael Jordan tell you how to dunk from the free throw line and being like, okay, I'm going to go do that. No, these guys are like the best to ever do it. Right. So just because they say something, it can be intellectually fascinating. It's probably almost never a good idea for your typical retail investor. So sorry to hammer that point home. I agree with you.
Great point. One other thing I love that he said is when you're cold, the last thing you want to do is make big bets to get back to even for Michael Jordan. One of the Michael Jordans of Michael Jordan would never say that though. Michael Jordan would be like, well, I'm not cold. I've never been cold, so I wouldn't know.
But that goes to your Tim Ferriss thing from a couple of weeks back where you're going, hey, if you lose money, think about trying to make it back in a different way than you lost it. And think about trying to make it back with a different time frame, a much longer time frame than just being like, oh, I was at the blackjack table. I lost it. I'm going back to the blackjack table to make it back because this is not going to happen.
Precisely. This is a phenomenal interview, wide-ranging conversation, hits on multi-decades of views. Thoroughly recommend it. It'll be on our Substack on Monday. If you want to join our Substack, skippydoogles.substack.com. And also you mentioned putting it on the Twitter at skippydoogles.
Love it. Thanks, Douglas. All right. There's other things to talk about, but I think we better dive over to the listener mails and make sure we do that justice.
Well, I mean, if we want to do it justice, let's start off with the listener mail jingle. Then we hop in. Here's that jingle.
They fight and fight and fight and fight and fight. Fight, 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 fight. The Skippy and Doogles show.
Okay. You want to talk debt first, or do you want to talk bear markets?
Well, let's talk debt. We got listener mail specifically asking about my thinking as it relates to debt, because on the pod I'll often say, that's a high debt company, so probably not a fit for me, or probably not a fit for the value investor methodology. I'm going to talk about that a little, Doogles. I want you to jump in with questions, and then, gosh, I could talk about this for hours and hours. We'll try and keep it to a few minutes or less. So if you're fishing in the cheap stuff, right? If you're looking at things that are fundamentally cheap, I'm talking equities that are trading near book value in some cases, or PEs less than 10, or price to free cash flows less than 7. Like, historically, you make money buying those cheap stocks, but it's not a guarantee. Sometimes investments like that are priced that way for a reason, right? They're fundamentally priced that way. I would say they're always priced that way for a reason. They're usually unsexy businesses that are out of favor, or businesses that are struggling. Maybe they're in an industry that are changing. I mean, Kohl's is a holding of mine right now, largely an acquisition play, but Kohl's is super, super cheap. Well, why is Kohl's super cheap? Because when's the last time, Douglas, that you were like, oh, I can't wait to go shop at Kohl's? Like, no one says that unless you're a 65-year-old grandma, right? Kohl's is that price to cash throw of 3, if I remember correctly. Like it's super cheap. So those are the stocks that I typically buy. How you get absolutely screwed when you buy stocks like that is if you buy companies that are actually going to go out of business. The way companies actually go out of business when they're super cheap is they have revenues that are falling off. They're probably not making much money, and they have lots of debt. So I have this extreme aversion to companies with debt, in large part because you have to if you're a value investor. So I'm just going to talk through 2 metrics that I look at. They give me a lot of peace of mind, help me sleep through the night, that no, this company's not going bankrupt anytime soon. And then I think mean reversion is on my side if they're at 52-week lows with super cheap fundamentals, and I know there's no chance of them going out of debt. So the first is simply debt to equity ratio, right? So equity is assets minus liabilities, right? And in the simplest sense, you can think of equity as retained earnings, right? If my business makes $100K a year and I pay me $50K, I still have $50K in the bank. That is the equity in my business. And effectively, that's cash that I can do what I want with. So if I have $50K in equity and I have, I don't know, $5K, $10K in debt, that business is on solid financial footing, right? I'll pause and just make sure I'm articulating this clearly.
Yeah, that all makes sense.
Okay. If it's the reverse of that, let's say I have 50,000 in retained earnings, which I'm calling equity in this case, and maybe I have 500,000 in debt. First of all, who's the bank that gave me that debt? Because they're idiotic. But second of all, how have I proven that I'm going to cover that debt burden? Now,
So
Dougles,
now you're not buying the stock and you're shorting the bank.
Probably. Yeah. Now, Douglas, in the growth startup world, I mean, it's a totally different equation for you. So the example I gave is pretty extreme, and I'm not saying you would be buying that stock, but in some cases, early stage companies that are all about growth, and we just talked about the 8 companies that lost $15 billion in the Derek Thompson article. Like, those companies probably didn't have great debt to equity ratios. I don't know, because I didn't invest in any of that nonsense. But other people did. And so it's just where I play that makes things like debt to equity ratios so important. The other one that almost always look at is the current ratio, which is just current assets over current liabilities. Typically, current means the next financial year. So just call it next 12 months. And if you have a bunch more short-term assets that you could effectively convert to cash at any time you need than you do current liabilities, you're not going out of business anytime soon, right? So those things, my focus on debt simply helps me sleep at night and knows that the business that I'm buying is on really solid footing. And that pairs well with knowing that the business that I'm buying is also dirt cheap. And that changes the equation for me, where it's like, this is effectively a no-lose proposition if you have the right mindset and the appropriate time frame.
Very well said. I think you articulated that really well. And we do have different views. I am also generally debt averse, but it depends on the company. This the listener mail was asking specifically about yours, so I'll just spend 30 seconds just discussing, because you mentioned it is different. I do think about, because the companies I'll invest in, I'm looking for multiples of returns. And so I'll look at, how are you funding your growth? Are you funding that through earnings? That's best, right?
Yep.
Are you funding that through equity? That's pretty expensive. And a lot of times, like putting out more shares, that dilutes my ownership. Are you funding it through debt? And in some cases, if you're a capital intensive business, especially, you might be funding it through debt, but what are the terms of the debt that you have? Is that long-term low interest rates? And so there's a lot of nuance that ends up coming there. But for me, I also don't like to see low cash balances and high debt, unless you've proven, which this is hard, but unless you've proven that your cash management historically has been really solid. And generally speaking, these types of companies don't have enough history of specifically of like cash management for you to be able to know, but it's a different viewpoint.
Yeah. Well, the other thing I'll mention, and this could get way deep in the rabbit hole, is you can change your capital structure by bringing on a bunch of debt in a way that makes your return on equity and other metrics that people look at, return on assets, artificially inflated with what I'd call financial engineering, where you're like, well, look at this return on equity. It's 50%. Well, that's just because you have so much debt on your balance sheet that your capital structure is really debt heavy. And so the stocks I invest in don't have those crazy return on equity figures typically, but they also almost never have much debt. So it just all ties together in a way that you can paint a picture that looks really rosy and not have a sustainable business model, too much debt.
And a phrase that I've often enjoyed over the last like 20 years is, you can be profitable but bankrupt.
Yeah.
And that comes down to the importance of cash flow management, which is where one of the places that debt comes into play.
Yep. There we go. Very well said.
All right. I get a little bit giddy over the question that Jared asked. Jared, thank you for the listener mail. I added a few points to the housing conversation that we had. And the question that was asked here is there any research, info, theory out there that suggests that because having better technology allows quote unquote normal investors / consumers greater access to information, that both bear markets and bull markets are more contracted or shorter? Great question. I got feels around this. And I ranted on the bear market side. I ranted about this about 7 months ago. And I believe you just didn't care. Skippy, was your reaction?
Sounds like me. Yeah.
Yeah. I'm going to start off with the bull side, actually, because this one's shorter. It's hard to say that bull markets are shorter now, because we just had the longest bull market that we've had, like that. So it's just difficult, like to talk about that one. Although I do think the question is still interesting. The bear market side, the answer is yes. There are theories. I've seen them, and I'm going to give my 2 cents on what those theories are. I'd love your reaction, and then I'll give my own view, which is a little bit different. What I've seen out there kind of comes down to 2 points, but the answer is typically I've seen that there's a good amount out there that says, yeah, we think bear markets are shorter. And it's one, because central banks these days are propping up markets more so than they have historically. And two, what part of what you said there, Jared, around information being out there, more retail investors being involved, which increases like information volatility, right? What do you want to call it? Efficiency. Let's just kind of call it. I've seen versions of that are out there that say that bear markets are becoming shorter. I have a different view, but that's some of what I've seen out there. What's your reaction to that, Skippy?
It's all so complex. What's the blank adaptive systems jargon that everyone throws around? Complex adaptive systems, right? So like there are so many factors that go into the price of an individual stock. Then there are 500-ish individual stocks that make up an index. Then there are interest rates, which make each of those stocks more or less expensive. Then there is human behavior and the attention span, which I think has changed for the shorter. So I think it's really hard to make a conclusion because of how complex and how adaptive this system is. Is that a cop-out answer?
Yes, but it's a real answer. But I agree with what you said. I'm just giving you a hard time. Here's my view. I think that when it comes to our bear markets getting shorter, my real answer is no. At least that we don't have enough evidence that says that. But I actually think that the reason I say the real answer is no is because I think that the definition of bear market is faulty. And this is the thing that you said that you didn't care about a few months ago.
I still don't care about this 7 months later.
Yeah, here I go. But I'm back. Someone asked about it, so I'm back. So in December, we had an episode called Like a Bear in a China Shop. And in that episode, I went on this rant, which Skippy just ended saying, I don't care. That was about the definition of a bear market being wrong, right? And the reason I believe this is because of the definition of a bear market is from the top to the bottom, at least 20% down. And typically someone's looking at the S&P 500 when you say like the market isn't a bear market, but you could do it for any index. You could look at the NASDAQ, you can look at Dow. But so from the peak to wherever you are, right, there's at least a 20% decrease in price. That's typical. I think that definition creates a lot of noise, is basically what it is. And so you end up having these bear markets, and bear markets happen pretty frequently within that definition. So if you just take the S&P 500 and go back to 1950, so it's like 72 years of data, we've had 16 bear markets according to that technical definition during that time. So it's like every 4 to 5 years, you end up having a bear market, right? And most of those, it's like a few months that ends up lasting, right? I think on average, if you take them all, it's over a year, but that's because of the long ones. And that's what I think is important. And so to me, I don't know what you want to call these things. I think the reason you say you don't care is because like it's just a bunch of words we're throwing around, like who really cares? But I think it's important because oftentimes when the term bear market's thrown out, it conjures this image of like a full-fledged crash. Like that's the image that like we're in a bear market. And so it's like doom, gloom, fear, uncertainty, doubt, like all this stuff comes about. But oftentimes it's just like there is uncertainty and investors don't like uncertainty. So they pull their money out and just wait a little bit. And then that uncertainty is over. And so they come back in. And so you'll see like we're in a bear market now. We had a bear market in 2020. There was a bear market in 2018, right? Like, and for 2018, 2020, like once folks saw a light on the other side, you jump back in. And that's not as important to me as are we at the start of a multi-year drop, which that's a little bit different. I'll pause now because I know you want to jump in.
Now you're it's better the second time around, Doogles. We already have the Doogles indicator, right? Here's what we're going to do. I don't know what we're going to call it yet, but there is something brilliant here. And you got to trademark this as soon as possible to say it's not only about how far down it went, but the slope of that pullback. And so each bear market should be classified like we classify tornadoes on the Doogles scale. And then we have something to talk about. I want this to happen.
I like where this is going. I think that's exactly right. That when you have just a certain number of terms, correction minus 10%, bear market minus 20%, right? When you have a limited number of terms, you have to lump a bunch of stuff into it. You don't have the stratification that we have with like hurricanes, tornadoes, etc.
Yeah. And when you start to stratify to say, from 1929 to 1934, that effectively negative slope is much more painful because it's over 5 years than the 2021, which you hate ever got classified as a bear market. Like that, I know that bothers you. Yeah. That keeps you up at night.
Tingles my toes.
So US, let's do this. We're gonna break some bread over this, and we're gonna pull out some napkins and make the Doogles. So we're gonna have the Doogles indicator and the Doogles scale for bear markets. It's gonna work.
it's gonna. it's gonna. But yeah, I like that. And to throw some numbers out there too, Jared, like if you if you look at the last like 50-ish years, the bigger quote unquote crashes, whatever you want to call them, that we've had, there was the one that happened in 1973. It took about 6 years to get back to break even. You had 1987 that took like 2 or 3 years, I think, to get back to break even. You had 2000 that took 4 years, I think, to get back to break even. You had 2007 that took 4 or 5 years to get back to break even. That's pretty recent. And so you're looking over 50 years, the big dips have all taken like a good amount of time. It's just that I think maybe I'll even throw this out. With more information now, more retail investors are cognizant of when a bear market happens. Like they happen pretty frequently. More people know that they happen. So it probably feels like they happen more frequently than they used to, and therefore feel shorter because you hear about it more and then see a recovery. And because we've been in this long bull market, you've seen a number of bear markets during that bull, 3 or 4, like during that bull market, and it's always recovered. And so it probably just feels like bear markets are recovering faster. But my answer is that they aren't. Well, or we don't have enough evidence to say that they are yet.
I think that's fair. I take this question in a slightly different direction. When Jared talks about more information being available, easier ability to trade stocks, I think of behavioral economics professors Richard Thaler and Cass Solenstein, who do great work all over the place. They just came out with a revised version of Nudge, which if you haven't read it, you should. And they did a study, or maybe they just brought a study to my attention. Maybe someone else led it, where they talked to people about, I think it was specifically stock trading. And they did like 3 things. They'd give them 2 pieces of information and ask them what they'd pick. And then they gave them like 5 pieces of information and ask them what they pick. And they gave them 10 pieces of information. And generally, the stocks that people picked remained the same, regardless of how much information they had. What changed is their conviction in the pick. So when they had like 10 pieces of information and they bought Exxon and Exxon went down 50%, they weren't selling the thing because they were like, no, look at all these metrics I have. Like, I have so much confidence because I got more information. And so I think there's something at play here where you just go Google and you get thousands of articles that confirm whatever bias you have. And you can go to Robinhood and Morningstar and E-Trade, and then you can go to Seeking Alpha and you can go to whatever else. And I think potentially that could make the downswings quicker because there's more overconfidence.
Yeah, you do also have to think about the fact that retail investors are a small percentage, relatively small percentage of all investors. It's more material now than it has been for a while, right? I think we're like around 20%, 20% of the market is made up of retail investors. It's something like that. And so retail investors can't fully, like if you take 20% for a second of retail investors, if every institution, this is an impossible scenario, but if every institutional investor was like, the things are going up and to the right, and all retail investors said it's all going to fail, then you'd only just hit a bear market, right? Like you could only lose like 20% of the market. So you need, I know it's like, I'm just doing it to make a point. Like you actually need both institutional and retail to create a significant downward spiral to happen. It can't just be one of them. And so you could say increased information generally, not just for retail.
Totally. And let's just be clear about the fact that the so-called pros deal with the same psychological challenges that your retail investors do. Yeah, they're definitely not immune.
Great questions. These were great questions. Love it.
Yeah, thanks, guys. Hope we did it justice. If not, hit us up and we'll go into more detail anytime you like.
All right, we closed out.
Yeah. You know where to find us. One-stop shop, skippydoogles.com, Twitter, Substack, skippydoogles@gmail for listener mail. Thanks again for that. And we'll see you shortly.
Thank you.